If you looked at your portfolio in the last month, you have probably noticed that it is dropping, and you have probably noticed that gas prices are spiking pretty heavily right now. It feels like just everything overall is more expensive lately, especially because the Fed is not cutting rates. We have the Iran war driving oil prices higher, and the market is reacting very quickly to this. But the truth here is that this is not just random chaos today. I am going to break down exactly what is happening with the economy and what it means for you. I want to make sure by the end of this video you feel confident with how to optimize your finances here. Before we jump into the video though, go ahead and comment down below. Are you currently worried about the economy right now, or are you just staying calm and investing through it? I really want to see where your heads are at right now for me. I am still feeling very calm and investing through it. I reached my first $124,560 in net worth by staying calm when things got ugly. I remember when I had $0 and I was driving a 2006 broken car just to save for VOO. Let us start out by talking about why the stock market is dropping right now. If you look at the S&P 500 as of today, it is about 8.5% down from its all-time highs. This has all happened in about a month or maybe a month and a half. It basically started once the Iran war began. That is the first reason the stock market is dropping, because we have geopolitical risk and oil shock. Because of this current conflict, we have completely disrupted global energy as a whole. When you see tensions rise near a major shipping choke point, traders instantly price in higher risk. Whenever we see higher oil costs, this leads to broad price increases across the entire economy. Energy feeds into almost every sector from transportation to production. Oil is actually used in way more things than people realize. About 20% of global oil actually moves through that strait. Any threat there causes immediate volatility to different prices and markets. Investors know that oil is a big inflation driver. When energy costs go up, inflation sticks longer. We saw this in 2022 when inflation started to take off and oil was the only sector that did well. The second reason now is actually because of Fed policy and uncertain interest rates. If you asked people 6 months ago what the Fed would do in 2026, they would say cut rates, but right now that is remaining unchanged. The Fed is in a weird position and they are keeping rates steady while looking at inflation. They are factoring in this geopolitical uncertainty and how that looks for our economy. They are leaving rates steady even though inflationary pressures are starting to rise. This tells us the Fed is willing to tolerate higher prices. For now, markets interpret that as a lack of direction. That is another reason they are selling off, because they love when the Fed cuts rates. Let me give you a little macroeconomic lesson from what I remember in college. Basically, the Fed wants our economy to do well, and they do not want inflation to be high. If inflation goes up, the Federal Reserve increases interest rates. They increase interest rates indirectly by increasing the federal funds rate. It is the rate at which banks loan money to each other. If banks loan money at a higher rate, they pass that on to the consumer. This is called counter-cyclical policy. The Fed is in a weird position because if inflation picks up, they may have to increase rates. Because the market thinks rate cuts might not happen, it pushes yields higher. This makes growth stocks look a lot less attractive. You are even seeing this with big tech companies like Microsoft trading down significantly. Now, another reason is because of higher borrowing costs and yields. Due to the war and inflation expectations, U.S. Treasury yields have climbed. When you have higher yields, investors demand more return to compensate for risk. They pull money out of risky assets like stocks and put it into safer bonds. The 10-year yield increases also pressure sectors that rely on cheap capital. These are your tech and growth stocks that you are seeing get killed right now. Higher interest rates make future earnings less valuable when discounted back to today. Stocks need to get stronger to justify their valuations. Those are the main reasons why the stock market is dropping. Now, I want to briefly talk about my fear for what could potentially happen. I am not trying to fearmonger you guys, because we will talk about how to take advantage of this. My actual fear is a repeat of what happened in the 1970s. This is something called stagflation. Stagflation is the combination of slow economic growth plus high inflation plus high unemployment. In the 1970s, we saw oil price shocks drive up costs while weak productivity froze growth. Real wages fell even as prices rose. This is a nightmare scenario for most people. Things are going up in price, but wages are not going up to account for it. We see a couple of parallels to this today because we have rising energy prices. We have inflationary pressure that has not fully eased yet. We have a Fed that is very hesitant to cut rates. Consumer sentiment has been sliding for a while now. Inflation continues to grow, but wages are not following that. It makes it harder and harder for the everyday person to get by. Another parallel we see is a lot of stock market volatility. It is a very familiar energy and policy mix to the 1970s, but there are a couple of big differences that I still want to point out. The U.S. economy is a lot less dependent on oil today than it was in the 1970s. We are a much bigger oil producer now and not as reliant on imports. Inflation is not at extreme levels yet, but if energy stays elevated, inflation could become sticky. Why do markets hate stagflation? When you have high inflation, your real returns are eroded. If you get a 12% return, but inflation is 6%, your real return is only 6%. You have to factor in inflation when looking at your total returns. On top of this, you have slow growth, which means earnings could stagnate. If you combine those two things, stocks offer a lot less upside. The valuations of huge companies start to shrink and get smaller. That is why markets are selling off in response to everything going on. Your next question is probably, what can I actually do about this? The first thing I would say is make sure you have a very solid emergency fund. I am talking 3 to 6 months of your monthly expenses. When the economy is uncertain, that is the best time to have a solid cushion. The next thing I would say is to actually focus on fundamentals. Do not just read the scary headlines. Markets are always going to go up and down. Geopolitical tensions will always make headlines look worse than reality. Try to keep your perspective on things. A short-term volatility does not mean we are going into a long-term collapse. Think about the tariff situation last year. The market sold off 18% in a month and then it completely bounced back. The same thing could be happening right now. The market is only down about 8.5% from its all-time highs. We are not in full-on bear market territory yet. I do not think there is any need to freak out, even if the market drops for the next 2 years. You only need to focus on income. Make sure you can pay your bills and keep investing on the side. This is where the opportunity is going to really kick in. Stay invested, but make sure you are at least somewhat diversified. That is why I always invest into index funds. I am not focused on one single sector of the market. You could own things like VOO, which are the 500 largest companies in the US. You could own VTI, which is the total US stock market. You get the large companies plus the medium and the small companies. You could pair those up with VXUs, which is an international ETF. If you want to own every stock, you could also own VT. This is not financial advice. It is just how I stay diversified. I do not want all my money in a couple of tech stocks hoping they bounce back. If you are not just betting on one sector, diversification helps you big time. If there is high inflation, you might see oil stocks go up. We have already seen that with ExxonMobil and Chevron this year. Certain sectors like technology may do bad, but others may do really well. Consumer staples and defensive sectors usually hold up pretty well. Making sure you have different sectors in your portfolio is really important. That is the beauty of just owning ETFs. You do not even have to think about it. You can just keep investing consistently. Investors often buy when the market is doing well and sell when it is doing bad. That is the complete opposite of what you want to do. I follow the Money Guy Show method, and that is to always be buying. I was buying last month, and I am buying this month. When you see the market dip, it is an opportunity to buy at a discount. If you are bullish on the US economy, you should be excited. I think we will always bounce back and continue to grow. Do not try to sit there and time the market. Just keep investing consistently. I have already maxed out my Roth IRA this year. I am focusing on the brokerage in the 401k. Stay consistent, and this will pay off if you have a 20 or 30-year horizon. You should also try to position yourself for inflation. Inflation can be hedged indirectly through real assets. Things like real estate or dividend-paying stocks or inflation-protected bonds. I am not saying to gamble on random things, but having exposure to a lot of different things helps with inflation. This is how the everyday person takes advantage of this. There is a lot of opportunity provided in tough times. When the market drops, we are getting lower valuations and lower entry points. If you were buying VO at $600 and thought it was great, be happy at $500. Now your $1,000 investment goes further than it was before. You are buying more shares of the exact same 500 companies. These corrections reset valuations. Long-term investors buy in at lower prices, which benefits them when things stabilize. Lower valuations are a great thing in my opinion. I do not stress the stock market doing bad. If it does good, I am making money. If it does bad, I am lowering my average cost per share. I am buying things on a discount and I am confident things will bounce back. Even if it takes a couple of years, I am okay with that because time is on my side. Another reason for opportunity is sector rotation. When you have uncertainty, energy and materials often outperform tech. Utility stocks and staples usually hold steady. This could give you a chance to buy good tech stocks on a dip. That is what I do with VOO. The main takeaway is that we are in a pretty weird environment. We are not at 100% stagflation yet, but risks are higher. When we have geopolitical risk and rising costs, it creates volatility, but remember, do not panic. Take a deep breath and stay the course. The economy is not collapsing tomorrow. Markets swing with emotions just as much as they do with data. Position yourself wisely and keep diversifying. Make sure you have your emergency fund and your savings built up. Educate yourself on how these conditions affect your life. That is what is going on in the economy right now. I hope you guys enjoyed the video. If you did, drop a like down below. Hit that subscribe button. I will see you in the next one. Peace.